Okay, awesome. And we are recording. So welcome Badgers, and thank you for joining us today during our homecoming, and specifically for joining us during this fireside chat centered around current banking trends. My name is Daniel Stranges. I work at Brock University within the Goodman School of Business as an alumni coordinator. During this virtual homecoming, we have alumni joining us locally from across Canada, as well as internationally. Knowing this, I would like to begin our presentation today with a land acknowledgement, where we recognize the Indigenous communities that originally inhabited the land on which we have come to gather today. Brock University acknowledges the land on which we gather and the traditional territory of the Haudenosaunee and Anishinaabe people, many of whom continue to live and work here today. This territory is covered by the Upper Canada Treaties and is within the land protected by the Dish with One Spoon Wampum Agreement. Today, this gathering place is home to many First Nations, Métis, and Inuit people, and acknowledging reminds us that our great standard of living is related to the resources and friendship of Indigenous people. Before we begin, I do want to go over some housekeeping items. Firstly, this webinar, as well as others throughout our homecoming event, will be available for viewing in the on-demand section within the Homecoming Hub. So I encourage you all to explore the Homecoming Hub following this session to add any events to your agenda that you may have missed, as well as learn more about the perks and benefits that come with being a Brock graduate. Finally, we encourage you to type any questions that you have throughout this presentation using the chat box functionality, or raise your hand and ask the speakers yourself. Simply just click the chat at the bottom of the screen to access the chat box. It will be monitored and brought to the attention of the speakers by Darren. About our speakers today, I want to welcome Roelof Makken, who is educated in the Netherlands, Canada, Belgium, Chile, Peru, and Bolivia. He is a strong believer in the immersion of educational pursuits, global exposures, workplace experiences, and currently is a professor in the Goodman School of Business. With his career started in corporate and investment banking at TD Bank, Citibank, and ABN AMRO Bank, he has seized opportunities to work with the largest hedge funds and institutional investors from around the world. Aside from his career endeavors, Professor Makken can be found rowing, playing the piano, or looking after his crop farm. And in addition to that, we have Michael Quinn, who currently heads up corporate coverage for Credit Agricole Corporate and Investment Bank, which is based in Toronto, Canada. He has worked in corporate and investment banking for over 19 years for Credit Agricole, and previous companies he has worked for include MUFG, the Royal Bank of Scotland, and as well as ABN AMRO Bank. Michael holds a BA in history from Brock University and an MBA from the Richard Ivey School of Business at the University of Western Ontario. With that out of the way, ladies and gentlemen, please give a warm welcome to Michael and Roelof. Fellas, take it away.
All right, well, thank you, Daniel, for the nice introduction, and thank you for having us to talk about banking. We hope that this session is going to be quite interactive, so we encourage people to use the chat feature. There are basically 6 quick agenda items that I want to sort of cover in this presentation. Is that on the first one is basically our journey. You know, how did we end up sort of in the magic world of banking? Mike, how did you end up being a banker? You seem like such a nice guy. You studied history, and you've gone to the dark side of the world. How did that all happen? And were your parents happy?
Being a nice guy, nice person, merge. Yeah, all I can say, I mean, I'm a bit humbled to be a speaker. It seems like yesterday when I was on the other side, an undergrad student at Brock, all I can say is the grads is go out and pursue your dreams, because trust me, the time flies. It seems only like yesterday. But yeah, no, I was did my undergrad at Brock in history. Part of my dark past is I actually did a master's in history/international relations after my undergrad. But then I went to Japan for a year, and I think gave me a more of a global perspective. So I was in Japan for a year. Again, amazing experience. That was on the JET program. So if people are interested in that, it's a great gateway to that culture. It's a government program. I was working in a Japanese high school for a year. You get interviewed by the consulate. You're technically an employee of the Japanese government. Isn't that pretty interesting? So I did that for a year. I came back. I then went down to Mexico for a few months to get some more cultural immersion, study Spanish, and then I had to go get a job. I figured that was the right thing to do. Didn't make sense. So I did something that made sense, which was, global finance. I really like global, like different cultures, being similar to you, Roelof. The whole global perspective just really fit with my mindset and my academic studies and just the way I thought about things. And so I started working for one of the Canadian banks in brokerage, back office job, got a license, went to the front line, not advising people, but just brokerage. And so it was a great experience. And then I slid over to asset management, worked that for a couple of years. And then I went back and did my MBA. And again, all this makes kind of makes sense in hindsight. I then went to get some more cultural experience, leveraging off the fact that I'd studied Spanish before. And I worked during MBA 1, MBA 2 at IB. I worked in Mexico for Scotiabank in Verlat, in banking in Spanish. So that was very interesting in corporate banking. So my first taste of the corporate investment bank side. Ultimately graduated and then started with ABN AMRO. And that became RBS. There was that little merger that took place, which I think is still the largest bank merger ever. And I was with ABN AMRO / RBS for 12 years. And RBS retracted back to UK and hub Western Europe due to kind of the macro regulation, UK ring fencing legislation, which is a fancy way of saying sucking capital back to home country, making it difficult to remain a global bank. So RBS in 2015 exited 24 countries, including Canada. And again, this kind of molds into this whole evolution of banking, right? I think global banks and Canadian banks make it look very simple. When you're in banking, you realize how complex the regulation is. And as bankers, we really make it look easy. And we have to manage things on the back end because clients, frankly, don't want to get dragged into the mess. They just want to get loans when they need loans. They want to get advice on things like M&A and cash management and other ancillary services in a timely manner and get service. They don't want to be dragged into the mess. But there's a lot going on under the hood in terms of banking in general, and especially global banking, because you're dealing with multiple jurisdictions. So after RBS, I actually got recruited pretty much immediately to go join MUFG. And RBS at a point in time was actually the largest global bank, just in terms of size, but people don't appreciate in Canada, the largest global bank at a point in time. MUFG at the time I joined was, I think, the 5th largest global bank and still kind of sits in there. And I was there for 3 years as a senior banker, again, client coverage, covering primarily energy and resources. And then I was recruited by Credit Agricole to head up the corporate banking, corporate investment banking in Canada. So I'm the managing director in Canada. So I've been doing that now for just over 3 years. So again, the journey makes sense after the fact. It's still fun, keeping me engaged and excited. Sometimes too excited, but with that, that's probably again a nice kind of segue to pass over your Roelof. But that was my journey. I always wanted to work in global corporate investment banking. Really, the global aspect intrigued me and still continues to. But and the one thing I'll add is you never stop learning. I mean, recently I took a course from Oxford University, now virtual, in private markets, private equity, private debt, and again, that just because it's so in your face, private markets are quickly eclipsing public markets. And that's been the trend for a while, since 2009, when the global credit crisis forced banks to kind of step back. And I'm sure we'll get into a larger discussion there, so I won't steal Roelof's thunder. But maybe that's a good chance to pass over to yourself, Roelof.
Yeah, perfect. What intrigued me when I met Mike for the first time, and that was actually in the corporate setting. I did not know him from my Brock days. It was simply he ended up working together with one of my former colleagues, and we ended up at a big conference somewhere. And then my former colleague says, "Hey, by the way, Michael Quinn I think he went to Brock as well. So, and that sort of started a friendship. And so we have been having lunches and coffees ever since. I think what is interesting, I think as a takeaway, Mike, is that the two different routes that we ended up getting to sort of, in the end, sort of on the corporate investment banking side, it sounds to me that I came in through the front door. I was super lucky. I always consider myself super lucky. You came in through the back door, through that back office. And yet, we ended up doing reasonably similar things. You stayed with the banks. I decided to sort of leave the banking side. But so I think for the students in the audience, I think it must be encouraging to say that, look, there's many ways of getting to maybe where you would like to go. And but it takes some, I think, critical success factors. And I think one of them that always stands out to me, Mike, is the need for authenticity. You have to be authentic, you need to be inquisitive, and honestly, if on the corporate banking side in particular, you have to have a global perspective. And something I really love about your resume, Mike, is it's reminded me a little bit of my own, is of course, you could be Dutch the way I am, like cheap and cheerful is sort of my mantra in life. If you can learn Spanish, go to Latin America and do some immersion, and it can be actually a quite affordable, enjoyable experience, not just linguistically, but also culturally. I think your Japan program was totally intriguing. I studied Japanese at U of T. I'm sure that your approach was a lot more effective than mine was.
Survival.
Correct, absolutely. Now, Mike, you've done the journey of the big banks. I've done sort of the journey of the big banks, but what totally intrigues me about where you are today, Crédit Agricole, a huge French financial institution, it is a bit of an unusual duck in the pond, isn't it? They're big, they are powerful, but tell us a little bit more about what makes Crédit Agricole such a different animal. And of course, the element that I'm sort of most intrigued about, of course, is the cooperative nature of Crédit Agricole.
Yeah, and I think, just to explain the bank in a nutshell. So the bank is large, it's global. It's the 10th largest bank by assets. So similar to MUFG, similar to RBS back in the day, very large, very global. So it's, if you're one of those top 10 banks, by definition, you're more complicated. There's lots of pieces. It's a job on the front end that you're able to explain what your organization does in a succinct way. But more importantly, when you're talking to clients, what's relevant to them, as opposed to pulling out a book of War and Peace and dragging the client through everything the bank does, which would not be a relevant conversation. So in terms of, Credit Agricole, it's in 50 countries. That's the Credit Agricole group. Sorry, let me turn that off. Somebody, I did not mute my phone, the classic mistake. And I just did that now, so this is bringing in the background. So the Credit Agricole group, 50 countries, there's different pieces to it, which I won't get into, but part of it is the Global Corporate Investment Bank. But the Global Corporate Investment Bank, it's part of this total whole where, the bank, has very large pieces. Like we have Amundi Asset Management, which is the largest European asset manager. And I think currently the 8th largest globally in terms of assets under management. So trillions of dollars under management. Again, Credit Agricole Group, it's a cooperative model. So it's a bit of a hybrid. It's not like the Canadian cooperatives, credit unions, like a Desjardins or Meridian, citing one of our hometown champions. Credit Agricole is approximately 56% owned by 39 regional banks in France. And so, there's about a 44% public float, but I think, it's on record, I think Credit Agricole is the largest co-op, just by virtue of the fact it's 10th largest global bank. It's pretty massive. The total equity of the group, there's 142,000 employees, 51 million clients. And, basically in terms of 8,400 branches in France alone. There's a very large retail presence in Italy. That's kind of like the cousin to France. So it's, again, very global, very complicated, but, the teams work together, and it's very corporate. Just because it's a co-op type model, it's very corporate really the thing that's different is really the source of the capital. So in a lot of ways, as you look at the transition to private markets away from public markets, in a way that, you know, this is a hybrid model, right? This is might be one of the models of the future that really become more common. You know, and the credit unions in Canada are you know, very similar, right? And again, everything's going to private equity and private capital. A lot of it, you know, public markets will not disappear, but it's certainly an interesting model that way. But very corporate in the way it operates. Just part of our shareholder base happens to be 39 regional banks, and we like them because they don't require dividends. They're happy to plow their capital back into building the business, and as a result, like our tier 1 capital, I think today is about 16%. Actually, I might even be a bit low. I think it's actually 17%. But it's, you know, again, fortress level capital ratios, which is, you know, obviously very important if you want to remain, you know, A-rated bank. All banks learned that lesson during the credit crisis, that you need to manage your funding, and if you can't manage your public ratings and those go below, those start to drop and start to dangerously go towards, you know, BBB plus. You can't really cite many global banks. Well, in fact, you can't cite any global banks that don't have A ratings, right?
Yeah. So, Mike, if I can just sort of interject, then, so it is a cooperative bank at heart. It does have this public listing feature. So all these cooperative regional banks are sort of shareholders in this public sort of entity. It's quite inspiring, isn't it? Because it's a beautiful blend between social and community engagement at the local level, right? The cooperative bank, as you refer to, very similar in that sense to the Mouvement Desjardins. Some of you must have seen Caisse Populaires when you're visiting Quebec, or even in Welland, we have a few of those. Also a very successful structure. But what I think is beautiful about this Crédit Agricole format is that you have the good things about the cooperative bank, and yet at the same time access to the capital markets. And that, of course, is always a big problem during financial crises, as what Mike was referring to earlier. You know, boy, when there is a liquidity moment, like where banks need cash, where do you find the cash? Well, you cannot just always rely on governments to bail you out. You know, can we issue shares as one of the avenues of raising funds? So for those of you in the audience who are working for credit unions or for the credit union system, I think this can be quite inspirational that, look, credit unions are not the largest financial institutions in this country, but actually you could move from small to actually fair sized. On the credit ratings, what is interesting is the strength of Crédit Agricole as a cooperative bank, but also the Dutch Rabobank, also one of the larger banks in the world, and they are actually active in Canada as well. Again, with extremely high credit rating. So it's quite interesting that actually some of the cooperative type banks, large ones, that's to say, have actually held up quite well during the crisis as well. Mike, is there a drawback to the structure that Crédit Agricole has?
You know, I would say, you know, if you're working for a bank, any other global bank, you know, your initial impression is like, do I want to go work for a cooperative bank, right? It is a different structure.
Correct.
The way the bank manages that is that the bank recruits very carefully. I guess give myself a little pat on the back. You know,
only nice people.
Yeah, only nice people. Very self-serving comment on my side, but I'd say, you know, they tend to recruit. They recruit. They're not afraid about recruiting very senior people. They put them in local jurisdictions, and they've got this global sort of global expat class, which tends to circulate around as being country officers within the different jurisdictions, and also too some of the local people. Eventually, if they want to, if you want to go to France, you can go to France. It's a very global culture, but again, they recruit carefully, and it's one of those banks that if you want to have a very long career, I mean, I can't tell you how many of my colleagues are, been with the bank for 20, 25, 30, 35 years. I mean, like, so it's kind of an old school model that way. If you're 10 years with a bank, you're a newbie, so they tend to recruit, and people tend to stay a long time. And so that's a strength. But I think that's a strength maybe as a result of they have to recruit carefully because they want people who are comfortable with this model and can be successful in this model. And you can be successful. I mean, in terms of that corporate investment bank, it's critically important to the CA group because, for example, we've got top tier capabilities. We're like, for example, I think for 2020 we were the number 3 Euro bond house, right? So if you can access the Euro bond market, and we've got leading equity capabilities in Europe, and we're also very good as a global shop. I mean, but you can then get access, capital for the CA group, right? So that's part of the purpose of having a corporate investment bank. It's also to make sure the organization, albeit in a hybrid one, has full access to the capital markets, which it does, right? And so that's part of the long-term stability and success of the model. You hire the right people for the right jobs, and corporate investment bank is very important to make sure your access to the markets remains solid for the bank, but also clients that you're doing great business with.
Well, it's quite interesting. It's amazing to see the tremendous deposit base that your bank has. So in that sense, a very strong retail bank with a lot of agriculture, agri-food sort of lending as well. And yet at the same time being number 3 in the Euro bond market. So that's actually super interesting to see. Just as a side note for everybody, the role of banks really has changed an awful lot. I've been doing a bit of studies on it, like how have banks evolved over time. And it is actually quite an evolution because original banking really started sort of as trade finance. Banks were not, people were not supposed to make loans. And it's very clear if you look at sort of Sharia law and sort of in the Quran, or if you look at sort of the Protestant sort of, or the Catholic sort of readings on it, on usury and the views on lending, banks were not supposed to really exist. Of course, they started to exist because as farmers needed to expand, they needed funding to do the land expansion. So the early days of the bank, the way we know it today, was 80% of it was agricultural lending. And as the Industrial Revolution happened, it became industrial finance. And if you look at post-World War II, it became consumer finance. And what is interesting to me from a historical perspective is that banking came about as a productive pursuit in the past to support basically trade and production, to whereas banking seems to have shifted, the public banking that is, has shifted very much sort of in the domain of the consumer market. And if you were to look at most of the big banks around the world, including the Canadian banks, you will find that retail banking is really the big chunk of their balance sheet, or more specifically, real estate lending. So it looks to me that banks have become more and more real estate lenders and may actually have verged away from some of those activities from, let's say, 50 to 100 years ago. So you wonder what has happened. Hasn't industry grown? Hasn't international trade grown? So what are we really doing in that regard? What, of course, happened in the world of the Big Bang in the 1980s, when we had the big push for liberalization of financial markets, we were beginning to see the financialization of everything. And you actually begin to see a massive increase in sort of lending, cross-border lending, and especially consumer lending. But we were also beginning to see a massive increase of issuance, for instance, of debt, bonds, for corporates in the over-the-counter markets. So what we were seeing, especially sort of 80s, 90s, that banks were saying, look, we do not necessarily want to put stuff on our balance sheet, but we much rather collect the fees on creating the transaction. So we originate and sell sort of the products that we have just designed. And so that fee-driven model is still very much alive and well. And of course, that has led to things like mortgage-backed securities, other collateralized debt obligations, and you name it. But it looks like the trend is actually continuing. The regulatory framework works have changed very significantly. Of course, the financial crisis of 2008 was a big shot across the bow for most financial institutions that folks, this may be out of control, we need to regulate. But I think little did the regulators or the legislators, especially in the United States, realize that their regulations are in fact contributing to two things. One, fewer banks, especially in the United States. And secondly, a massive increase in transactions that are taking place in what I always call the smoke-filled back rooms at law offices. Now, I'm exaggerating here a little bit. It's not as shady as it may sound in my sort of discourse here, but it is very interesting that the private markets have grown quite dramatically. And I think one of the big drivers, a couple of drivers, I think, behind that is, one is the actual cost of capital. Mike made a beautiful reference to the fact that, Crédit Agricole has a very solid balance sheet with 16% tier one capital, for instance, which means it's actually incredibly well capitalized. It's also necessary in order to ensure the continuation of the credit rating that they have. But to actually make a commercial loan or to make a corporate loan is actually quite expensive for a bank nowadays. And so it may be cheaper to go through the bond markets. On the private side, and especially on the equity sides, banks have never really taken much equity sort of on their own books. We have seen the tremendous increase in private debt and private equity transactions. Now, Daniel has been nice enough to pop up the slide already, and it gives you a bit of the sense of the tremendous growth that has taken place there. And I sort of want to talk to Mike then for a minute, given that he took a course, given that he sees this world every single day. We have some of these numbers up on the slides. What's your interpretation, Mike? What's going on here in the world of private activity in the financial markets?
Yeah, I mean, my first blush reaction is, the critical period was, well, see, I won't get too much into it because there's probably a larger discussion with the whole introduction of Basel. As you go to Basel III and Basel IV, and these are really the international regulations on systemically important banks in terms of regulating capital. So whenever you make a loan, you have to set aside some capital, which sounds simple, except then you have to measure it. And you have to put aside reserves and capital for it, and that's a cost. And it just makes it more expensive to be a global bank, but a necessary one, because 2009, the financial crisis, was a perfect example when these rules were less far advanced. Everybody can really see, fortunately in Canada, we seem to bear up well, largely due to, OSFI, and to be honest, maybe some luck on our side too. But you see in the U.S. that havoc took place when suddenly credit crisis, banks realized they were overextended. They were relying way too much on finance themselves in the short-term markets. And when the short-term markets shut down, there's the panic ensued. I mean, everyone forgets how quickly Goldman Sachs, had to get bailed out. Does not say something, and they're pretty smart folks. Lehman, Bear Stearns went bust. Merge, bought, different scenarios. Case myself, RBS, the largest global bank. You suddenly realize tier one capital we'd run in at that time. Everyone's a huge fan of Sir Fred, who used to head up RBS. He was actually, I believe, on the front cover of Times as CEO of the year. Everyone forgets that. And then he was pilloried and tarred and feathered soon thereafter with the credit crunch, because suddenly people realized you can't run a global bank, the largest bank in the world, and they had a series of acquisitions. They're on an acquisition spree, buying up everybody, growing furiously. But the tier one capital at the time, if I recall, was 5-6%, which turned out to be far too low. And they were financing themselves, as all other global banks were, and banks globally were financing themselves way too much in the short-term markets. So when you suddenly realize that short-term funding mechanisms all seize up, it's like everybody's staring like a deer in the headlights, going, "Oh my God, what have we done?" I remember talking to syndications desk. I won't say the person's name, but at the time, he's still in the industry. I remember phoning up, and he said, "You wouldn't believe it." He goes, "I was on the desk yesterday, and for a brief moment in time, talking to other bankers and syndications, I think things actually stopped." Like everyone, if banks actually stop syndicating and lending to each other and trusting each other, then you're in a whole different ball of wax. I mean, but if that had happened, I think, it would have been a much different situation. But fortunately, I think there was a brief pause, and then the bank said, okay, we're going to still keep on working. We're going to trust each other. And there was a whole lot of navel gazing, trying to figure out who had derivatives exposure to Bear Stearns, Lehman. Everyone else is going down because they had, derivative exposures and off-balance sheet exposures to everyone else. So, and no one was measuring and tracking this stuff. And that's what a lot of the new regulation forcing people to do. So if somebody like, for example, the Chinese property developer in China, which is having issues now, it's not quite the same issue, still a big issue, but not quite the same issue as it could have been before, because I think now everybody's tracking who's got exposure to them directly and indirectly and off balance sheet, and people are forced to report this stuff. Now, maybe in China, you don't have the same level of transparency yet, but certainly in North America and other jurisdictions subject, you're going to know what your exposure is, right? So the contagion there is, less of an issue, it's more contained. But back then, no one was thinking about that because no one foresaw a situation where the short-term markets would seize up, and then suddenly everybody starts navel gazing, say, what exposure do I have? What exposure do they have? And they have. And if everyone stops trusting the system's done, right? Where at that point, you start reverting back to a much more basic banking system, like Roelof says, where banks before, their raison d'etre to be international is really just trade finance letters of credit to, ship goods so people can ship stuff in a schooner across the ocean and trust they'll get paid, right? That's pretty basic.
Well, I think it's interesting, right? I mean, the lesson learned really has been that I think we take too much comfort in that high volumes in financial markets means that there is liquidity. Volume is not equal to liquidity. So for those of you in the audience who have taken finance and you look at sort of these efficient pricing models where you basically assume continuous markets, might just refer to a situation where there is no continuous market. It just, the world stops. So it's just an air pocket. It's like having turbulence on the plane, and it can be a very nasty drop. It can also sometimes be just, oh, was that it? It wasn't so bad. So let's please not get fooled. Let's quickly, the clock is ticking, Mike. So we have the slide up on the growth in private equity. Very quickly, 2 trillion in 2012. The expectations are for 225 in 2025 to have 9 trillion. So all of you can see a tremendous projection in growth. And this is based on what we have already seen and what we still see every single day. Something else I wanted to bring home as well is that the number of listings on the New York Stock Exchange have actually been in decline for about 20 years. There has been a slight pickup in this past 18 months, and that is basically, I would say, thank you, SPACs, special purpose acquisition companies, literally pools of cash that are listing themselves with some smart, known person leading it, suggesting that they're going to invest in some funds. But what is interesting, there are a lot of firms that also are growing, but are growing into the private space. They are not necessarily listing themselves anymore. And some of it is regulation driven. Some other things is also, I think, innovation driven. If you are publicly listed, you have to disclose your latest sort of findings, and you want to make sure that you're not sort of creating an information asymmetry situation. If you are a technology company and you're onto something totally new and exciting, at one point you may have to disclose that to your public shareholders. Is this the time to necessarily open up the kimono, right? Do you really want to share this and make also your competition fully aware of it? Another one close to my own heart, of course, is in the mining industry. Let's say we have done some drilling out in Northern Ontario. We have 2 or 3 very prolific holes. As a public company, you should be reporting these holes. You told your shareholders you were going to drill. You told them what your expectations were and why your expectations were formulated the way you did. And now you have the findings. The problem is that if you have a very good hole, it may drive up your stock price, but it also may actually make it very difficult for you now to make acquisitions of land sort of around your sort of property. So the whole idea of having public versus private is quite interesting. For a bank, Mike, then on a going forward basis, how do you think Crédit Agricole is going to take advantage of this big move towards the private deals? How are you capturing some of the fees?
So, I think, in terms of the general trend, if you think about the credit crisis, right, in the increasing use of Basel 1, 2, now we're in the 3, going to 4. I mean, it's that capital you got to set aside when you make a loan as a bank. That makes it more expensive to make loans. And especially, that's why you see the Canadian banks as a whole, even domestic banks, they're not banking. It's very expensive for them to lend to the lower middle market. So you see where the private debt is coming up and lending there because they can lend at a cheaper rate. They can take more risk. And it seems very basic, but it's you think about it, banks have to set aside capital. If you're a private debt fund, you don't have to set aside capital. You're not regulated like a bank. So you don't have the costs, you don't have the same level of know your client compliance, which is heavy, same operational restrictions, right? You're doing a very focused activity. If you're doing private lending, maybe you're doing private equity. But again, you can do these activities, be very focused, and you can be more cost effective and you can make money. Unlike the banks, where it's going to be very difficult for them to, if they're regulated, it's very difficult for regulated banks to go too far down that credit curve, right? So you see the rise of venture capital funds for private equity, some of the Canadian tech champions, new unicorns. These are all very focused financial sponsor models, right? Private debt funds, private equity funds, venture cap funds that are essential because it's harder for banks, which are increasingly regulated, to do certain types of activities. So they have to stay away from or divest and get out of those. But private sector can pick it up. So that's that in the regulation, financial reporting. But it's just the ability for some of these new players to be better at doing some of these activities, because the banks are very difficult for banks to operate and be regulated at the same time in these activities. As a bank, what do? We've got an asset manager, Amundi Asset Management, one of the largest. Amundi does, what do? They're an asset manager, private equity, private debt, so you can't do those activities within the regulated bank model directly. And that kind of makes sense, right? I mean, as I get older and I'm in banking long enough, I think OSFI is like the best friend we have, okay? Because in Canada, they're making sure that they're the regulator of all the banks in Canada, including the foreign banks, and they're going to protect, especially the Canadian banks, right? They're taking Canadian deposits, right? You don't want people to get their deposits wiped out. So OSFI provides a level playing field, regulated playing field for everybody. And so I have no problem where these other activities are done separately, when you're not putting at risk, to be frank, retail depositors, right? And that was the whole purpose of Glass-Steagall in the US, which got pulled back. And that's probably one of the big reasons why you had the financial crisis in 2008, 2009. And then, what form do you go back to essentially protect those retail deposits, right? And that probably is a follow-on conversation on fintechs, et cetera, but I'm not going to steal your thunder.
Well, Mike, it is interesting, right? So a couple of issues that I see coming out of your comments here is that for the small and medium-sized enterprises, accessing money through the banking system is actually still quite difficult, and that is very much regulatory driven. Second comment that I think is appropriate here is, in the 1990s, we may remembered Treasury Secretary Rubin during the Clinton administration was very big on the notion that maybe we should have the financial supermarket, get all your financial services provided by one entity. No surprise that this guy became a big boss for Citibank at one point. And here we are a few years later saying that no more financial supermarket. And I think when you listen carefully to Mike's observations, maybe we should almost shift back towards the Glass-Steagall Act from the past, where you had sort of nice divisions of retail banking, corporate banking, commercial banking, insurance, and assets under management or asset management. What is interesting about Michael's comment as well is that if the bank can't deliver, the asset management unit probably can, right? They are the players really that are able to accommodate private equity deals, for instance. So there is hope and scope. Wow, the clock is moving fast. I very quickly want to sort of have a few little bullets here. Is how do we see the bank in the future? I've done some thinking about it, and we'll open up the floor as well to some comments and questions. One, there was a great question about regulatory environments for the private market. Mike, do you think that the regulators will jump into the private market as well? So in other words, the noises that we're hearing from, yes, you guessed it, Elizabeth Warren criticizing the SPACs, thinking that we should be regulating that. Do we see already some movement on regulation of privates? And if that is the case, who is actually in charge of that? Because the Office of the Superintendent of Financial Institutions, OSFI, is really more banking driven, whereas these instruments are really asset management driven. It's sort of the who is the regulator, and what do you see for regulation?
Well, there's OSFI. True. I mean, what is their mandate? I guess you could look, on the private markets, there's a separate regulator, for example, if you're a mortgage broker, and that's the closest analogy I can come up with, right? But in Canada, there's a separate regulator, and I won't spit out the acronym, I can't remember off the top of my head, but that's separate from OSFI. So there is always a regulator there of the mortgage brokers, right? And if, I'm sure if the government wants more regulation, I'm sure they can figure out how to put more regulation in place. Hopefully they don't put too much regulation in place, because it could kill that the desire to do more business. And so it's trying to strike that right balance. And I think, I've got some friends in the private debt space. I've got some other friends who are mortgage brokers. I mean, it is developing. I mean, and I'd say if I was a grad today, would I go into corporate banking? I think I'd probably look at the private markets. That's where the growth is. You're going to find a niche. And it's really putting together the people that are looking for capital, so your lower mid-cap companies, and the people that have capital, right? It's basically, it's as basic as that. You got to put together the two pieces of bread and with the ham and rye and with the ham in between, right? So it's not that complicated, but it's still less regulated. It's got some regulation. So I think there's a lot more growth there, but at some point, the government will step in and probably regulate some more. There was a bit of a hiccup, you recall recently. I think it was Bridge Financing was the name of the company. They had a bit of a hiccup on the private debt side. I think what kind of helps the government and the politicians, though, if you put money in a private debt fund and you lose money, you knew what that money was going to be put to work for. It makes some money. If you're a retail depositor in a bank, and that bank goes under because of a bad private equity, bunch of private debt deals, if you're a retail depositor, you're probably not thinking your money was going to be used to make some higher margin business, right? So there's a more direct connect with that. You're dealing with informed investors. Although at the end of the day, if it's fraud, somebody has to pay for that, right?
Yeah. No, a great little observation here from Hali about do you think credit unions would take over banks and lending services? I don't think they will take over, but what I think is evident from the presentation from Mike and the role, for instance, of Crédit Agricole globally, Rabobank in the Netherlands and also globally, that you can be a cooperative bank and be very good and also be very big and also be very profitable. In Canada, it's quite interesting. French Canada, the province of Quebec, honestly, the cooperative bank rules, right? They are really the big player and very, very successful at what they do. All right, I just want to make sure that we have some time still for a couple of questions. Are there still any other questions out there out in the field?
Yeah, I just want to invite everyone, if you have additional questions, please type them in the chat as well. If anyone does want to come forward, raise their hand and actually ask their question on camera, feel free to do so. There were some questions in the chat. Did you guys, one of them was, given the most recent relatively high CPI inflation metrics, what is the probability that the interest rate might turn negative?
Oh, perfect question. I am horrified, honestly, with the monetary policies as they are being conducted. You may recall, for those of you who've taken economics, that increasing money supply, increasing the size of the balance sheet of the central bank, increasing money supply, provided that there was a transmission mechanism back into Main Street, that this will lead to inflation. And I think we have seen very clearly that the dramatic increases in money supply in 2008 to do with the real estate crisis in the United States, this time the massive increase in money supply in response to COVID and the massive fiscal stimulus, we have seen the impact, a massive rally in the bond market, and that's always the first step. Subsequent to that, especially with COVID and the income support programs across the world for regular retail public, real estate prices have also exploded to the top side. We see tremendous strength in some of these theme stocks in the equity markets, and now you begin to see inflationary pressure is picking up in the background. I have this horrible feeling that we are addicted to easy money, and negative interest rate environment may be here for longer than we hoped that it would stay. I actually did some reading up on it about what people have done in the past when you had high levels of government debt. I looked at France, given that we were talking about Crédit Agricole today. And it's actually interesting, in France, they let inflation pick up quite significantly after World War II as a way to really reduce the government debt to GDP ratio. In other words, that was their way of getting the money back and to get public finances back in place. I am absolutely horrified that we are thinking so lightly about inflation. Having spent a tremendous amount of time in Latin America, you can see the ravages of inflation, and we are actually playing with fire. I'm horrified, and it's actually very horrifying because if you look at the budget deficits that we have in Ottawa, they are actually fully monetized by our central bank. At this point, we do not need the level of income support that the government is currently giving.
And then another question that I want to bring to your attention. Do you think credit unions would take over banks in lending services?
Yeah, I sort of addressed that earlier, Daniel, but glad you bring it up again, because what is interesting in the Canadian context is that not everyone is subject to the same rules. So the regulatory burden on our systemically important financial institutions, so think the big five, Royal TD, CIBC, BMO, and Scotia, for instance, they are subject to much more rigorous rules than, let's say, your local credit unions would be. And the reason is, one, these big banks are federally regulated. Credit unions are provincially regulated, but also a credit union is deemed to be not systemically as risky. The basic business model for a credit union is actually pretty straightforward. We take deposits and we make loans to our members, right? And it seemed to be a lower risk profile. And I say it seems to be a lower risk profile, assuming that we'll not see some unfortunate events on the real estate side, especially commercial real estate. I see a good question here too. For young people who have very little knowledge about banking, what are some of the most important things they should know before to look into? First of all, read the papers a little bit. Who are the players, right? What are these banks and what are they really doing? Seriously, I had no idea when I started in banking really all the different silos that exist within the bank and the different types of jobs that exist within a bank. So my suggestion to all my students always is as well, please make sure you have as many conversations with people as possible. For those of you in the audience today, both Mike and I will be delighted to talk to you offline as well. Have a coffee, have a call, have a whatever, just to enlighten you a little bit more about the full suite really of banking roles and responsibilities. Because some of the jobs, like the areas where I was in, I think you had to be a little bit more of an extrovert and super global. There's also parts of the bank where basically being an extrovert may actually be a negative. I don't think I want to have people that are too extroverted in risk management. Mike, any thoughts?
Yeah, well, actually, I wanted to highlight, there's a news story in the Globe today, which kind of highlights some of the points we're trying to make. So there's an announcement, Teachers, which is one of the largest Canadian pension funds, is buying the alternative lender Home Equity. And they're basically one of the largest players for doing home equity mortgages, okay? And their Teachers is buying Home Equity for undisclosed price, i.e. private deal. So you'll never know what the price is unless you're a Teachers or Home Equity. And it's interesting to note that Home Equity was, growing their business, and they're still going to have the mantra to grow the business. Well, one of the ways they were financing themselves before Teachers bought them is that they had placed, for example, with other lenders, 175 million, for example, with Concentra, because Concentra, part of the credit union system in Canada, was looking to grow that part of their business. So, and the previous owner of Home Equity, it wasn't a publicly listed entity, it was actually Birch Hill Equity, which is a private equity fund in Canada. So you see all these players. Do you see anywhere public markets? No. And this is basically one of the largest mortgage players in Canada, right? So it kind of highlights, what's going on, beneath the hood here, is that public markets are still relevant, but becoming less relevant. So people should, look at other aspects of the market, the private markets. But again, there's lots of opportunities there. Yeah. The problem is it's private. So, if you do a bunch of work to figure it out, you'll be better positioned and more knowledgeable than a lot of people, because you can't read about a lot of this stuff in a lot of detail in papers. Yeah, also, have a look, and this is why I'm big on actually reading, the Globe and Mail report on business and these and the Financial Times and these sorts of things, because if you look at who are the players involved, a transaction that we looked at was Hudbay working together with Ontario Teachers Pension Plan again for an acquisition in Spain, where Ontario Teachers was going to be a major financier for this transaction. So again, you can see a pension fund is taking the role almost of what a bank sort of used to do. So you can really see how the world is sort of converting or changing, and that the role of the conventional banks is actually, in my view, very much diminishing. As a macroeconomist, that is super interesting, because our monetary policies, how we conduct them in Canada or the United States or Europe, was always, you do your open market operations, you buy those bonds, you drive down interest rates, and it trickles down to the regular banking system to the places where you want it to go. Except that channel, that gearbox, is not necessarily the same gearbox that we used to look at. We have all kinds of differential locks sitting everywhere on every wheel in the economy. So it makes fine-tuning monetary policy a lot more difficult. And this is one of the reasons I'm very horrified about sort of what we are doing currently in monetary policy, because on one of the PowerPoint slides, I also said, look at the firepower that you have with all these SPAC deals, for instance. These people have to invest all of that money within 2 years, and it's probably going to be with a leverage of about 5 to 6 times. So what they have issued on the NYSE is only, probably 20% of the actual footprint it will have in the financial system. All right, Dan, are you still seeing any other questions popping up?
Yeah, if you want to briefly, there's one last question I want to bring to your attention from Henrietta. And they ask, what is the place of cryptocurrency in the future of banking?
Roelof,
Henrietta.
answer that in 30 seconds.
Henrietta, I think it's a great question. Of course, everybody wants to know the answer. I was hoping to have tuned in yesterday to Professor Don Sears' presentation yesterday. I was encouraged to see that he was brave enough to address the world of crypto. I am concerned about cryptos because, in my view, this whole idea of decentralized ledgers that we're talking about sounds to me an awful lot like Hawala, you know, the systems that we have often in India, where basically there's IOUs on two sides of the world, and it's based on trust. And because we don't want the government to necessarily see, or we don't want to be transferring money from one jurisdiction to the next. Henrietta, where I think the magic sits is not the crypto itself. I think we will see very severe regulation on it, or maybe even banning, just the way the Chinese have done. But what is something that we should keep in mind is the whole notion of blockchain and smart contracts. I am very excited about that part of crypto. The fact that crypto has probably made some people an awful lot of money is, I would say, good for them. But I have great difficulties taking it seriously as an asset class, or actually to take it as an equivalent for money. I think it is a convenient construct to transfer money between jurisdictions where otherwise it would be very difficult.
Yeah,
right,
the only comment I'm add to that is, if you think about it as a form of transmission, the wire system you have globally, SWIFT, and SWIFT has been around for a long time. And the only reason SWIFT has been around is very old technology, but essentially to set that up, it requires all the different countries to give up a little bit of their sovereignty, a little bit of their control. So similar with Bitcoin cryptocurrency, countries have to buy into it, accept it, because otherwise they'll regulate it or just outlaw it. But you know, there's a reason why SWIFT and the wire system has remained in place. It's very old technology, but it's really a key thing. All the governments globally, you know, have bought into this and accepted it. To get them to immediately accept, it's going to take a long time for something to supplant SWIFT as a form of transmission, because it's trust at the end of the day.
Henrietta, I think it's a great question. And what is interesting is that the fellow who runs currently the Securities and Exchange Commission in the United States, Gary Gensler, he also taught or was lecturing at MIT. I know this is a Brock event. We, of course, have the best offerings of all, but MIT has a beautiful sort of online thing taught by Gensler, so the guy who is currently head of SEC, and his free-flowing lectures and discussions about crypto. You might find it super insightful. And it's actually, some lectures can be terrible to sit through, but actually that one is quite playful. Dan?
Awesome. I think that is it for time, but we answered all the questions. So a perfect time to end on that note. Once again, I would like to thank Roelof and Michael for joining us today. I know I speak on behalf of all the viewers today when I say that your presentation and discussion on this topic has been incredibly insightful and informative. We are so very honored to have the two of you represent us as Brock University alumni. And just a reminder that this webinar and all others throughout Homecoming will be available for viewing in the on-demand section of the Homecoming Hub. And lastly, thank you to everyone for taking the time to join us today. This concludes today's webinar, and I hope everybody has a wonderful day.
Thank you, Dan, for hosting. Just a quick follow-up. There is a survey, I understand. There's also 2 additional questions on the typical survey. I'm just curious if there's interest out there academically for a course in private markets, private equities, private debt, whether it should take the form of a course or a workshop. I'm sort of curious what your thinking is, either for yourself or in general, sort of as an observation. Second element, if you need to, would like to discuss this further, I'm still going to stay online, I think, for a bit longer, as long as Dan allows us to be online. But also, you can always reach me at rmakken@brocku.ca, and I will be delighted to sort of have a conversation with you one-on-one.
I'm happy to stay online for a while as long as Dan will let us, if people have questions. But also, too, I'd be very interested in seeing some seminar course, seminar maybe is easiest to do on private markets, I mean, honestly, what I took at Oxford, it just kind of highlighted for me. You just scratch the surface. You don't. It's kind of like you don't know what you don't know. But happy to hang around and